Money does indeed make the world go round. Today, money is available for every type of business. In fact, there's so much money floating around that the money managers are having a hard time. It seems there's more money available than great deals to invest in. So if you're looking for money to fund a new venture, to support your current business's growth, or to develop new products, the problem isn't finding money, it's coming up with a compelling reason for why the money managers should invest in your company. In other words, how do you tap into that money so your company can start growing? The market for deals involving private equity, an investment in a company in exchange for an ownership interest, is quite simply overheated and highly competitive. In fact, the whole picture has flipped upside down. At one time, entrepreneurs fought to stand out from the crowd of eager companies seeking funding. Now, the private equity firms are battling to get ahead of the pack so they can secure deals to keep their investors happy. Who knows how long this will last, but for entrepreneurs seeking capital at any stage, this is a happy time. The bottom line, you can't find money for an idea. Investors aren't stupid. A company that presents a great investment opportunity will get courted by the biggest of the big. If your company doesn't have the potential to scale and tap a very large market, if you don't have a secret sauce to keep competitors at bay, and if you don't have a management team that knows how to grow a company, you're out of luck. You need to go back to the drawing board and build something compelling that will get investors excited enough to invest. The term plan rears its ugly head when you start to figure out your financial needs. To successfully raise money for your business, you need to have a plan, as well as a backup plan and probably even a backup plan in today's business environment, because your chances of getting it right the first time or two are very slim. The goal is a funding plan that will guide your search and help you make wise financial decisions. A funding plan is really quite simple. It has 4 steps. 1. Carefully determine exactly what your company needs to research your goals. You have to plan for several stages of growth and financing. Initially, you want to have enough cash to launch the business and survive until the company is generating enough revenues to cover expenses. Beyond that, you'll establish some milestones, such as multiple customer segments, multiple products, and so forth. 2. Target your potential sources for each stage of financing. Based on the needs you calculate for each stage, you can decide what kind of money you need and who could potentially be the supplier. Remember, recognize that some first-round money sources will want to be paid back or cashed out, get their investments back, in other words, before the next round of financing, so make sure that you plan for it. 3. With the multi-stage plan defined, look at the various tasks you have to undertake to achieve your financing goals and get started before you need the money. Raising money takes time, so you shouldn't wait until you need it, when it will be too late. For example, if you need private investors, called angels, for your second round financing, you must start networking now. Angels don't just drop from the heavens when you need them. It takes time to build a business relationship so that you feel comfortable approaching the person about your financing needs and the person feels comfortable listening. 4. Keep tabs on your progress against the timeline you set. If you're significantly off from your projections, you may need to reevaluate your plan. Perhaps you were a bit too aggressive in your expectations. Keep in mind that you're in a hurry, investors aren't, so allow for some slack in your overall plan. As you can see from the funding plan, the kind of money you need to raise and the sources you need to consider depend on where you are in the life cycle of your company. Every business goes through several stages, each with different financial requirements. The following list explains the 3 stages of financial need. The first stage. This stage covers the period of time from the conception of the product or service through early startup. This is where the business concept is tested to make sure that customers want what you're offering. The second stage. This stage takes over when the concept is proven and your company is ready to grow to the next level by entering a new market, introducing new products, or developing multiple locations. The third stage. You reach the third stage when your company is looking for a liquidity event so investors can cash out, or you want to acquire another company or be acquired by another company. Each of these stages has different requirements and accomplishes different goals. You should know that high technology and internet companies often compress these 3 stages into very short time frames, sometimes months, and possibly even skipping the first stage altogether. What this illustrates is that to assess your financial needs, you need to understand the nature of the industry in which you're operating, the type of business you have, and your attractiveness as a company to the capital markets. You know that you're in the first stage of starting your business, when the easiest and most likely source of money comes from your own savings and friends, family, and fools. In other words, people who believe in you and your business plan. Entrepreneurs aren't bootstrappers because they want to be. They do it because they have to. Bootstrapping means finding money and resources, anything and everything they need, by any means possible, including begging, borrowing, and bartering. First stage money is hard to come by for several reasons. New ventures don't have a track record, so everything that investors and lenders see in the business plan is pure speculation on the part of the entrepreneur. New ventures often fail, so they represent perhaps the riskiest investments of all. Most new ventures have no intellectual property rights, proprietary assets, or secrets that would give them a competitive advantage in the marketplace. The founders of the venture themselves often don't have a track record of successful business endeavors. Most startups are merely Me Too ventures. In other words, they haven't identified a significant unfair advantage that makes them valuable to customers and investors. For these reasons and more, entrepreneurs have to bootstrap, rely on their own resources and the kindness of friends and family, or anybody else who will listen to their stories. Bootstrapping for a new venture has 3 key principles. Hire as few employees as possible. Employees are the single biggest expense of most businesses. Lease, share, and barter everything that you can. When you lease facilities and equipment, you avoid tying up precious capital that you could use to produce your product or service. Bartering also has become a popular way to acquire needed resources. In a barter arrangement, you exchange a product or service that your company offers for something you need from another company. Use other people's money. You can ethically use other people's money in many ways. Getting customers to pay quickly is one way. Convincing suppliers to give you more time to pay is another. The next section gives you an idea of what to think about when you're considering debt financing for your business or giving an investor an ownership interest in exchange for equity capital. Both are valuable financial resources, but you have to know when and how to use them. Debt is a financing source that is unfortunately near and dear to many an entrepreneur's heart. You know all those credit card offers that you get in the mail? Many small businesses don't throw them away. Instead, they've started using credit cards as their credit line for quick cash. It's an expensive route, but in a banking environment that isn't always generous to small businesses, going into debt sometimes is the only route that owners can take. In this section, we look at some of the principal sources of debt capital for startups and expansion. Commercial banks. Banks aren't very favorable sources of first-stage money for new companies, which isn't surprising when you consider that a banker's first concern is how a borrower will pay back the loan or credit line. If a startup company has little or no track record of sales, and most new companies don't, and it's offering the bank only projected sales, in other words, blue sky, a banker won't have much confidence that repayment is possible. Bankers operate under very strict guidelines, termed the 5 Cs: character, capacity, capital, collateral, and conditions. With no track record and only an estimate of expected sales, a new company has already violated at least two of the 5 Cs: capital and capacity. But what if you can show a track record from a previous business or from your personal financial status that's strong enough to warrant a loan? Depending on how you negotiate the deal, you'll receive either a secured or an unsecured note. We're betting that the note will be secured, meaning that getting the loan will require some form of collateral. Collateral is an asset of equivalent value that you pledge against the note, such as your house or a savings account. If you don't repay the loan, the bank has the right to repossess or foreclose on the asset. But even if that happens, your financial obligations don't stop. Just because you've lost the collateral for defaulting on the loan doesn't mean that you aren't still liable for the loan amount. Most bankers will ask you to personally guarantee any loan you take out, which means that in addition to any business assets, you're also pledging your personal assets against the loan should you default. Try to avoid this situation if at all possible. Of course, savvy bankers want to cover themselves any way possible, and they're holding all the cards when you really need the dough. Take the following quiz before making a trip to the commercial bank to see whether you and your business are ready to apply for a business loan. 1. Does your management team have the skills and expertise to execute your business strategy? 2. Does your company's financial picture look healthy? Positive cash flow, reasonable profit, some assets? 3. Does your personal financial statement look positive? 4. Can you identify your first source of repayment of the loan? 5. Do you have a second source for repayment? 6. Do you have additional security that you can use to collateralize the loan? 7. Do you clearly understand how your business and your industry work? 8. Can you demonstrate your character and trustworthiness? Make sure that you can answer yes to all these questions before you approach your banker. Set yourself up for success. Government sources. You can turn to governmental agencies to help fund your startup business, which is a good thing because it enables you to borrow back some of your tax dollars that went into government programs to support small businesses. Be forewarned, however, that any time you borrow from the government, you'll be dealing with a lot of paperwork and time-consuming procedures. Remember, it takes money to make money. Furthermore, the government moves at glacial speeds to respond to requests. Still, many a business owner has been saved from near death by an SBA loan. The Small Business Administration, SBA, is an agency that guarantees loans from commercial lenders for up to 90% of the loan amount. Using this program gives commercial lenders the incentive they need to take risks on small businesses. However, just as with any banker, the SBA wants to know that you'll repay your loan, so it will only lend to a business that has a bit of track record and is a healthy business. So, for startups, this may not be a reasonable solution. We recommend that you check state agencies and sources for financing as well. When you seek equity sources of capital, you're asking people to invest in your company in exchange for ownership interests, which means that you're willing to share ownership of your business. If you're wondering why you would do this, ask yourself the following. Which would you rather have? Total ownership of a company that struggles to get off the ground, or majority ownership in a company that's really going places? We hope you answered the latter. Remember, it takes money to make money. When you give people equity stakes in your company, you give them the right to attend shareholder meetings and voice their opinions. So you must choose your equity stakeholders wisely. Equity provides the investor or owner with four basic rights. The right to control the business. The person who has the majority of the stock controls what happens to the business. That's certainly true in a privately held company, in which the founder controls who gets stock and how much. In a publicly held company, by contrast, shares are bought and sold on a stock exchange, so a group of people joining together can hold the majority shares and control the company. That group may or may not include the founder. The right to dividends. Depending on how you set up your stockholder agreements, most shareholders in an equity situation are entitled to dividends if and when the company declares them. Dividends are a distribution of earnings to the shareholders. This is a critical point because most early-stage companies don't distribute dividends. Instead, they retain earnings to grow the company, which is a very prudent decision. Remember, entrepreneurs shouldn't seek money from investors who want dividends before the company is well established. The right to vote. Assuming your investors received common stock, they're entitled to vote at the annual shareholders meeting on such issues as the election of directors and officers and the direction of the company. In most cases, venture capitalists, professional investors, demand preferred stock, which gives them preference in a liquidation over the common stockholders. Normally, preferred stock is non-voting, but in some instances the investor may demand voting rights with preferred stock. Hey, whoever supplies the money wins. The right to company assets. Depending on how you write up the shareholder agreements, some shareholders could have claims on company assets in the event of dissolution of the company. Many factors come into play when you're deciding what kind of money you need for your venture. The following sections take a look at some key factors to consider when contemplating the choice between debt and equity. Why do you need the money? That question sounds simple enough, but few business owners really know why they're seeking capital beyond the very basics: to start the business, to grow the business, and so on. Certain types of capital work in some situations and not in others. For example, if you're seeking capital to finish research and development, R&D, on a new product called seed capital, you can forget getting a loan from banks, most venture capital firms, and frankly, most every other kind of investor outside of friends and family. That's because R&D is a big sinkhole. It requires a lot of money without producing any return for a long time, if ever. On the other hand, if you have a successful business and are looking to grow into new markets, you probably have several funding choices. And in today's global business environment, if you have a sexy internet business with a great business model or a high-tech venture in the energy industry, the world of capital is yours for the asking. Well, maybe not quite that easily, but you're certainly in a better position than 99% of other business owners. As a business owner, you no doubt want to control your destiny and certainly that of your business. Some business owners aren't comfortable with debt. They're obviously not baby boomers. So loans and credit lines aren't options. Others don't want to share ownership with anyone. They want it all, so equity isn't an option. If you fall into both categories, you have a real problem. You now have to rely on your own resources and the internal cash flows of the company. That may mean that you start and grow much more slowly than you would have otherwise. Nothing is wrong with that approach unless you're in a fast-moving industry. In that case, if you grow too slowly, you'll probably miss the window of opportunity and give a competitor a chance to bypass you in the market. The important thing is that you choose the financing option that meets your personal needs and the goals of your business. Although your personal preferences and goals certainly are important, they're by no means the only ones you have to consider. Your investors, if you choose that route, have their own goals which may be in conflict with yours. Unless you find that rare investor who has a philanthropic interest in seeing your business succeed, you'll deal with an investor who's in the deal for what it will return. An investor is looking at three types of returns in about 3 to 5 years. Cash flow returns. A working investor or owner sometimes receives the perks of ownership, such as an expense account, a company car, a salary, and dividends. Stock appreciation. At some point, agreeable to everyone, an investor can sell off a portion or all of his or her interest in the company and harvest the capital appreciation that the business has achieved. This is a tax-free event, up to the cost basis of the original investment. Also, if investors have held the stock the required length of time, they'll qualify for capital gains treatment on the gain, which means their tax rate will be much lower. Tax benefits. In some forms of business, for example, a subchapter S corporation or a limited liability company, LLC, losses and profits are passed through to the owners in proportion to their investment. So an investor can receive pass-through losses, typical in the early years of a business, and pay taxes on profits at the investor's personal income tax rate, which often is lower than the corporate rate. Second stage, or second round financing, generally is used to expand a business into new markets or new products. To grow rapidly to the next level, most businesses seek some form of expansion capital to cover the cost of building up inventories, hiring more salespeople, carrying out marketing campaigns, ramping up manufacturing, and so on, to name a few options. In this section, we look at several ways you can raise expansion capital. In the capital acquisition arena, an angel is a private investor and part of what's known as the informal risk capital market, which is the largest pool of investor money in the United States. Because the market is quite large, finding an angel doesn't seem like it would be a problem for an entrepreneur looking for funding. But it isn't that easy. You see, angel investors aren't listed in the phone book. Frankly, they usually prefer to keep a low profile, looking only at deals referred to them by people they trust. So the key to finding an angel investor is to get to know people who know them. Professional advisor types, such as attorneys, lawyers, bankers, and accountants, are possible sources. Other entrepreneurs are also good sources because most angel investors have been entrepreneurs themselves. That's why they like helping other entrepreneurs by investing in their companies. Today, many angel investors band together in groups so that they can invest in larger deals and benefit from a shared experience. They generally have rules about how much their members must invest annually, and they tend to fill the gap between friends and family money and venture capitalists, VCs. One thing angels typically do that distinguishes them from VCs is to spend a lot of time mentoring the startups so that they're ready for money. They also link companies to VCs when the time is right. Perhaps you've heard all the vulture capital jokes. In the minds of many people, venture capitalists are placed in the same category with used car salesmen and real estate developers. Why is that? Probably because although entrepreneurs want to build great companies, venture capitalists are in business solely to make money and get out as quickly as possible. They also want the following: a huge equity interest to compensate for the risk they're taking, an enormous return on investment, a seat on your board of directors. Doesn't sound very attractive, does it? To be fair, venture capital serves an important purpose. It provides the funding that fast-growth companies need to expand. Although plenty of venture capital is out there for the taking, fewer than 1% of all businesses meet the very strict requirements of venture capitalists. For high-growth ventures, however, VC money is an important source of funding, but it should be considered a second-stage source and pursued only if no private money is available. Some businesses, particularly high-tech businesses, and those with heavy asset requirements, such as plant and equipment, find it difficult to grow organically using internal cash flows. Growth is expensive, and to do it effectively, you need to move quickly. There are additional people to hire, systems and controls to put in place to manage growth, and inventories to build up in anticipation of demand by customers. All these things require large amounts of capital that most business owners don't want to divert from their current budgets. That's where VCs come in. This type of business is more attractive than a startup because it has achieved a certain level of success. Some of the risk has been reduced, and the business is positioned to grow. Today, private equity firms are receiving a lot of press. What exactly are they, and how are they different from venture capital firms? Private equity firms are simply investment funds that traditionally have focused only on very mature, low-risk companies seeking expansion capital. Their popularity is being driven by the number of companies looking to go private to avoid the stringent requirements of Sarbanes-Oxley. By contrast, venture capital firms take on riskier ventures at earlier stages and exert more onerous requirements on them. However, in recent times, the line between venture capital firms and private equity firms has blurred a bit, mostly due to the highly competitive state of the investor market. VC firms are now investing in more mature ventures, and private equity firms are taking more risk by investing earlier. If your company is in need of second-stage cash, another way you can raise capital is to do a public offering. A public offering is a complex version of a private offering that's regulated by the Securities and Exchange Commission, SEC. Your company agrees to sell a portion of its issued stock to the public via a stock exchange. The first time your company does this, it's termed an initial public offering, IPO. For a growing business, nothing is more exciting or glamorous than a public offering. It can be prestigious and very lucrative, among many other benefits. The public offering provides a way for founders and investors to reap the rewards of their efforts by selling off a portion of their stock. It gives your business instant clout with lenders and others who may not have given you a second look before. It's a way to raise large amounts of interest-free equity capital that you probably couldn't raise by any other means. You can use stock in the company as an incentive to attract top people to your organization. Because of the prestige of being a public company, it's easier to negotiate deals with suppliers, customers, and creditors, and to form strategic partnerships with other companies. With public offerings, market timing is everything. IPOs are subject to seasonality, which means that sometimes markets are favorable to them and sometimes they're not. Timing for the business is important too. One rule says to consider an IPO when your company's need for growth capital exceeds its debt capacity. You can use methods other than debt and equity to raise capital or find the resources necessary to grow your business. Very simply put, a strategic alliance is a partnership between two or more businesses, as well as an excellent way to share core competencies and reduce the costs of research and development, marketing, manufacturing, and distribution. Strategic partners invest time, money, and expertise in your company. They're really more like stakeholders. Strategic partnerships have helped many companies grow without having to raise costly outside capital and without giving up any equity. Strategic partnerships are particularly important to companies that do business in the global market. Often, you can't even do business in a country without having a partner in that country that knows how to handle business there. Alliances also are critical to small companies looking to compete in a big market. To be successful, a strategic alliance should be a win-win situation for both companies. To make sure that you create an effective partnership, heed the following advice. Find a partner that's financially healthy with or without your company. Find a partner whose business practices are compatible with yours and whose customers and value chain members are satisfied with their relationships with the company. Find a partner that has experience in strategic alliances, just as with a sophisticated investor, an experienced partner understands the risks and knows how to make the partnership work. If possible, find a company that has excess capacity so that it doesn't have to expend extra capital in plant and equipment to partner with you.